Ladies and gentlemen, good day and welcome to the Prudent Corporate Advisory Service Q2 FY2026 earnings conference call hosted by Equirus Securities. As a reminder, all the participants' line will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. This conference call may contain forward-looking statements about the company which based on beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Lalit Dio from Equirus Securities. Thank you and over to you, sir.
Yeah, thank you, Anjali. Good morning, everyone, and thanks for joining the call. To give a brief update on the 2Q FY26 results and address investor questions, we have with us from the management of Prudent Corporate Advisory Services Limited, Mr. Sanjay Shah, Chairman and Managing Director, Mr. Shirish Patel, CEO and All-Time Director, Mr. Chirag Shah, Non-Executive Director, Mr. Chirag Kothari, CFO, and Mr. Parth Parekh, Head Investor Relations. We would request the management to start with the opening comments, post which we can open the floor for Q&A. Thank you and over to you, sir.
Thank you, dear. Thank you. Good morning, everyone. I extend a warm welcome to all of you joining us on Prudent's second quarter earnings call. Thank you for taking the time to be with us. I hope you have the investor presentation handy with you, which has been uploaded on the exchange yesterday. So please, when I'll start talking about and you will give you the commentary, I'll refer the various slides. So let us begin with the slide 45. So this slide shows how our AUM has moved during the last quarter. So if you look at on this slide, on the left-hand side, it's a comparison of daily average AUM for first half of FY26 with our current AUM. During the first half, we earned revenue on a daily average AUM of about 1,15,600 crore. While our current AUM stands at about 1,27,000 crore when I'm talking to you. So that's an increase of about 11%, which gives us a strong momentum as we enter the second half of the current financial year. On the right-hand side, we have quarterly average AUM trend. The average AUM for the quarter, we close to 1,19,000 crore. This number excludes the Indus AUM, which was integrated in last week of September. We will start earning on that from October onwards. Our quarterly average AUM grew by 17% year-on-year and 8% quarter-on-quarter, reflecting steady business momentum. Now turn to slide 46. This slide shows the momentum in our equity AUM on a both year-on-year and quarter-on-quarter basis. Starting with the year, with a year-on-year view on the left, our equity AUM grew by 13.2% during Q2 FY26. It moved from about 1,03,950 crore in September 24 to around 1,17,650 crore in September 25. That's an increase of nearly 13,700 crore. This growth was driven primarily by strong net sales. Despite a negative mark-to-market impact, our retail investors continued their systemic investments with consistency. This highlights the resilience and confidence of Indian retail households. Another encouraging aspect we would like to highlight is our mark-to-market impact was negative by 1.4% compared to 6.2% decline in Nifty 500 in last 12 months. This reflects benefit of rupee cost averaging during the volatile but range-bound market, as well as an important role played by our distributor partners in fund selections and asset allocations. Coming to quarter-on-quarter view on the right-hand side, equity AUM grew by 3.3% during the quarter. This was driven by strong net sales of 3,600 crore and the addition of Indus AUM worth 2,050 crore. The key highlight here is that this was one of the strongest net equity sales quarter in the Prudent history. So now please turn to slide 47. So this slide highlights our SIP performance. As of September 2025, our monthly SIP book stood at 1,085 crore. We were added about 210 crore over last 12 months. This highlights the resilience and continued growth of our SIP franchise. Our market share has improved by 10 basis points from 3.4% in September 24 to 3.5% in September 25. we aim to reach around 1,200 crore in monthly SIP flow by March 2026. Now let us move to an important slide, which is slide number 49 of consolidated financials. So this slide 49 outlines our consolidated financials. On the mutual fund side, our quarterly average AUM grew by 8% sequentially, while mutual fund revenue increased by 9%. It's driven by stable yield and the benefit of an additional one day in this quarter. So as you remember, because of one day, our revenue has gone up by roughly about 3 crore, and that's the reason the revenue increased by 9%, while the average AUM grew by 8%. The heartening aspect is that despite a range-bound market, our quarterly average AUM grew by 19.8% on a half-yearly basis. During the same period, mutual fund revenue increased by 18.4%. Marginal difference between AUM and revenue growth on a half-yearly basis is primarily due to impact of back book repricing, which has started happening from August of last year onwards. Now I'll try and touch base the important aspect of insurance front. So on the insurance front, our revenue grew by 11.5% sequentially, driven by strong traction in fresh premiums. Retail health fresh premium rose 33% year-on-year, with the book now at 162.5 crore. You may notice a sequential dip in the insurance yields. However, as highlighted by us in our March quarter call, we at Prudent recognize the insurance revenue only upon confirmation from the insurers. Consequently, around 3.5 crore revenue of earlier period was recognized by us in Q1 of FY26, leading to a temporary base effect. Adjusting for this, yield remains stable sequentially, and the current quarter's yield provides a more representative view of future trends without expected impact due to GST-related changes. So now let me touch upon the impact of GST in the insurance segment. To be very honest, clarity is still not fully emerging. A lot of discussions are happening with the insurance companies. So I'll just share what the situation was during the month of October. November is not over yet, and the discussions are still ongoing. If we split the insurance business into life and health, GST impact has been quite different in both segments. In life insurance, out of, let us say, 100 rupees of premium which we collect, almost 30 rupees of the business got impacted by GST. That means roughly 30% of my life business saw an 18% cut in revenue because of GST which has been transferred to us. On the other hand, in health insurance, situation is exactly reverse. For every 100 rupees of premium which we have collected, 70 rupees got impacted by GST, while remaining 30 was not affected. But again, this was the position in the month of October. Final picture, the actual revenue impact and how arrangement will finally settle, we will be able to tell you only at the end of this quarter, which is after October, November, December is over. However, I thought I'll try and address, which is an important part, which is, I think, what is happening on the GST front. Now let me touch base another important point, which is regarding the revenue from non-financial product, and that also grew sequentially. However, on a year-on-year basis, decline was primarily due to the absence of liquid loan income in the current fiscal. In the previous fiscal, we earned 6.9 crore from liquid loan, out of which 6.2 crore was recognized in the first half itself. Consequently, this base effect will now taper off in the second half, and we expect a healthy year-on-year growth trend to resume on this line item. Now I think let me try and address the commission and fee expenditure also. So on coming to commission and fee expenses, we have seen an increase of 10% compared to 8.9% growth in the revenue, primarily due to an additional trail commission provision. This provision is made based on the net sales achieved by partners during the fiscal year. This scheme was introduced by us in August-September last year, and as a result, provisioning in the first half of FY25 was lower by 4.1 crore, with the majority of 19.1 crore was this, while the majority of 19.1 crore, which was the full year provision, was booked in the second half. Now for the current fiscal, we expect a similar total provision with 3 crore booked in Q1 and 5.2 crore booked in Q2. The incremental 2 crore provision in this quarter has temporarily lifted the commission growth relative to the revenue. That said, we expect lower commission provisioning in second half compared to last year, as provisioning is now more evenly phased throughout the year. Now coming to other income, which is the treasury income. While our operational profit grew by 7.3% sequentially, it did not fully reflect in overall profit growth due to lower treasury income. Mark-to-market losses on equity portfolio and lower yield on bank term deposit during the quarter led to partial reversal of earlier gains, creating a temporary drag on the overall treasury income. So during the quarter, there are two factors which has impacted profitability: lower other income and the recognition of an additional trail commission provision. This both put together is amounting to 4.3 crore. If we adjust this, then our profit growth has been broadly in line with our revenue growth. Now let me try and touch base the very important point, which is the recent announcement about the SEBI, which is a draft consultation paper. So, touching upon the SEBI's recent consultation paper on mutual fund, particularly the proposal impacting the total expense ratio. The first point is about the revised expense ratio, which will now be exclusive of all statutory levies, including GST. Earlier, only AMC's management fee attracted GST over and above TER. Everything else was considered inclusive of GST. So if, let us assume that I was earning 1% from the AMC, that 1% was including GST, meaning my actual income was 85 basis point and 15 basis point went to GST. Under new structure, my rate will be 85 basis point exclusive of GST, so I'll invoice GST on top of that and still effectively I earn 1%. So it's a revenue neutral for those who are registered under the GST, but a big advantage is that it removes the earlier anomaly, where a GST registered distributor earn less than an unregistered one. This creates a level playing field and help us attract smaller players to join the Prudent platform. So even though it's a neutral in revenue terms, it's strategically a huge benefit for us. Second point is the removal of 5 basis point of exit load, benefit of which has been there since 2012 for all open-ended schemes. SEBI has compensated slightly by increasing TR in first two slabs up to 750 crore by about 5 basis point, but overall the industry impact will still be a reduction of about 4 to 4.5 basis point on the TR because of this 5 basis point which has been removed. Third point is on the brokerage cost. SEBI has proposed reduction on brokerage on cash transactions to 2 basis points and 1 on the derivative side. Currently, we are of the view that AMC is paying roughly about 5 to 6 basis points. So this could mean an overall impact of 2 to 2.5 basis points, assuming one-time portfolio turnover ratio for the entire industry. So putting all this together, the exit load charge and brokerage reduction, total impact on the TR side should be in the range of 6 to 7 basis points. This impact, we assume that this impact would be shared by everybody in the value chain, be it the institutional brokers or RTAs or AMCs or even to the distributors also. And since it affects everyone, and whenever we always say that whenever the impact is transferred to the distributors, I am sure it will be transferred to everybody, and in that situation, we will also be in a position to share this pain with our distributors. But just a quick reminder, this is just a draft paper. SEBI has invited feedback till 17th of November, and there is a good chance that some relaxation may come either on the exit load side or on the brokerage. But whatever happens, I think it will probably it will dilute the impact only. That's why I thought I'll try and touch with this point to highlight what is changing, where the impact lies, and how it could actually turn out to be positive for the others. Now let me also talk about the ESOP plan which has been announced by us very recently. So we have granted 1,30,945 options to 388 employees. On the day of announcement, option value per share was approximately 542 as per CS certificate, which will be amortized over a period of next 12 months equally each quarter. So we expect a total P&L hit of about 7.10 crore, which will be booked under the share-based payment expenditure under employee benefit expenses. Finally, to conclude, we have successfully completed the merger of Indus acquisition. It's a very highly cash-accretive addition to our platform, powered by 15 experienced relationship managers under a seasoned business head. It is expected to deliver annualized mutual fund commission of about 22 to 23 crore and a cash profit before tax of approximately 15 crore. We continue to see a growing interest from distributors seeking alignment with scaled and technology-driven platform to ensure business and service continuity for their clients, a space where Prudent is well positioned and open to explore strategic opportunities. Our treasury corpus currently stands as 480 crore, provides a robust war chest to pursue select organic select inorganic opportunities and that are strategically relevant and value creative to us. With that, I would now like to open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Good morning, everyone. Sir, firstly, a broader question. Rightly towards the end of your opening comments, you mentioned about distributor addition, and you've added almost about 1,000 distributors in this quarter. Now, how is the landscape changing on the ground for addition of distributors? Because what we are hearing is there is a high competitive intensity to acquire distributors from many players, and therein they are sharing a much higher number in the first year from a commission perspective. We are hearing numbers as high as 80-90% in the first year as well. So, is that the landscape changing materially, and how do you see this going ahead?
Shirish?
So definitely, I think as we discussed earlier, I think there are a few more platforms have entered in the industry, and they could be the competition to the distributor empanelment. But on a positive side, I would say that more and more people working to get more distributors to the mutual fund industry. That is a positive thing. But on existing mutual fund distributors, the competition will increase. That is also we have to accept. Two things I would say here. One, more and more people will now communicate the advantage of platforms. Earlier, only two major players on a platform side were communicating the advantage of working with platforms versus AMCs. Now, at least 6-7 people will communicate the advantage. So, more and more people, MFDs will go towards the platform. So, that is a positive, and within platform will compete. So, I don't think that there is a big major impact on our recruitment side. To give you the number, I think last entire year we recruited almost 4,800 plus new MFDs or ARN holders in our kitty, and which was one of the highest in our history. So that says that in spite of increased competition, the number of ARN holders getting registered with Prudent and working with Prudent has not come down. Even if I talk about this financial year, YTD, we already have recruited close to 3,100. So proportionately, we are much ahead of what we did last year also. So in spite of increasing the competition, more and more people are joining Prudent platform. Of course, I think competition will make the case of working with platform stronger and stronger. So yeah, I think we are watching them, but as of now, I think we are not seeing any impact.
And my main question around that was the sharing of commissions with the distributors. Whether you will also have to kind of move towards what the new players are kind of giving the sharing commissions with the distributors, and would that mean some pressure on your profitability going ahead?
If you see, they are there in this market for almost more than 1.5 years. Since beginning, their commercial sharing is higher than what we offer. Last 1.5 years, we have not changed our strategy to increase our yield. Of course, I think that might give the pressure on a few smaller distributors getting attracted with the higher commission. But as of now, because of the competition, we have not seen any impact on our yield currently. So that is it. As of now, we are not thinking of changing our strategy.
And it is fair to assume that your sharing, which was slightly elevated, and you explained that there was some trade-related impact in this quarter, which will normalize to something like 60.5, 60 to 60.5% from Q3 onwards.
Yes, Sanjay,
sharing, I think.
Yes, sir.
Yes.
Yes, sir.
No, I think sharing, you are talking about 60.5% is not the truth. I think we are sharing roughly about, our weighted average sharing is in the range of 67 to 68% in the indirect channel. And there is a direct channel also. So probably if you just look at the mutual fund piece only I am talking about, because we do not provide the segment revenue. The mutual fund side, our sharing is in the range of 65 to 67%. And that probably, and then if you go to a probably higher band, I think that is significantly higher. So probably series has said that we have not changed the strategy. However, I can also tell you that on the topper end, I don't think we are very, very competitive. Only problem might happen at the initial level of the entry level players. Otherwise, our sharing ratio probably will try to maintain the same, which is currently there.
Got that. The second question is on the insurance side. Rightly you mentioned that the health insurance business is impacted more. But the communication from health insurance companies has been that the growth in the business, particularly in the month of October, whatever growth they have seen, will be more than enough to offset the impact of the commissions for the distributors. Is that a trend that you've also seen in the month of October, where the growth has been much stronger than what you would have seen in the first 6 months? So any color that would help us understand how the Q3 kind of will pan out for us.
So definitely one thing is for sure that because of health insurance becoming cheaper, the more and more people will try to go for the health insurance. They will try to increase the coverage. That also will help to get the higher premium. If you look at my October number, definitely if I look at my premium growth over August and September, we can see the growth over August and September. But it's too early to communicate that month of October, the growth in the premium is just because of reduction in the GST or the deduction going out. Maybe that could be the pent-up demand, because many of the investors, many of the policyholders, many of the distributors would not have participated in the health insurance in the month of September waiting for the GST cut. So it's too early to communicate that the growth in the month of October is mainly because of GST cut only. I think 3-4 months down the line we will be able to communicate that is there a genuine growth. But yes, October month we have seen the growth.
Okay. Last question is on the employee expenses. How much of ESOP costs were there in this quarter, and how should we think about ESOP costs for FY26 and FY27?
So I think ESOP cost has not been part of result which has been announced. So I already said in the opening remark that ESOP cost, because I think ESOP valuation will be happening on every quarter. But however, the day when we announce the ESOP, I think the option premium price calculation karne se, I think the cost was roughly about 7.1 crore. And we are assuming that 7.1 crore is going to be the cost for next 12 months. Starting from current quarter, we will amortize 7.1 divided by 4 every quarter. And now we'll, I think, make it a trend also that every October we'll announce the ESOP so that there should not be any, I think, the overlay of write-offs.
So the 7.1 crore will be over a period of vesting period, or it's 1 year cost?
So vesting period is after 12 months.
Okay. Got that.
It's a over a period of next 12 months, yeah.
Okay. Thank you so much, sir.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question comes from the line of Swarnabh Mukherjee from B&K Securities. Please go ahead.
Hi, sir. Thank you for the opportunity. A couple of questions from my side. First of all, in terms of the flows, so our net flows improved this quarter from the previous quarter, and I think SIP run rate also is better. So in October, what is the trend? If you could give us some color on that. And the second question is in terms of these impacts on from GST related impact on the insurance side and the overall impact on the mutual fund side, the potential impact which might happen due to the SEBI paper. How much of that can we pass on to the distributor? Will it be in that same sharing ratio, or in a you can able to pass it on fully?
This is.
So the first point is October month net sales is higher than what we did in the month of August and September, in spite of having the festive season. We could see that the momentum of mutual fund continues, the participation in liquidity continues, the gross flows and the SIP flows continued. So October month in terms of net sales is far better. Coming to the GST impact due to the insurance side, first on the insurance side, so mainly we will be able to pass it on in proportion to our distributor. So whatever would be the impact because of the GST, whatever will be passed on to us by manufacturer or the insurance company, we are very, very confident that we'll be able to pass it on the proportionate sharing cost to our distributor. So we don't see any challenge there in terms of margin.
Right, sir. And in terms of the potential impact of the SEBI paper, again, same question. How much will you be able to pass on in the same sharing ratio?
So in mutual funds, assuming that the final impact comes the way the consultation paper is talking about, we believe that we would be the beneficiary, because today our almost 33, I think 1/3 of our AUM is contributed, or rather I would say that the brokerage payout is contributed by those who are non-GST. So probably I think today they have got this tax arbitrage because of this, but they are not paying the GST on that. So we are very, very confident that we'll be able to pass it on the hit to them in ratio of what the current sharing is. Probably it might benefit also. So as of now, we are not saying that how much we'll be able to pass it on, but definitely it will be higher than the what sharing ratio.
Understood. That's very helpful. Thank you, sir, and all the best.
Thank you. The next question comes from the line of Dipanjan Ghosh from Citibank. Please go ahead.
Hey, hi, good morning, sir. Just a few questions from my side. First, in terms of, going back to the previous participant's question in terms of the mutual fund business, obviously, this circular which has come out, there was a previous version of this circular somewhere around May 2023. And I would assume that at that point of time, you might have had some discussions with the manufacturers or the asset managers in terms of how the distribution of this burden will happen between various stakeholders in the ecosystem. So based on these prior discussions and maybe incremental discussions that you might have had in the last, let's say, 2 to 3 weeks, what do you think or what do you sense would be the sharing ratio ballpark this time around versus, let's say, September 2019, where distributors were taking majority of the burden? And that's the first question. My second question is in terms of your MFT base. What would be the attrition rate, let's say, amongst your top 10% or top 20% of the MFTs? And maybe not for the quarter, but more from, like, let's say, FY25 versus 24 versus 23. I mean, is that, and even 1H26, how is that attrition trend really changing? I mean, that would give us some color of the competition. And third question is on the POSP business. And, given the fact that, we have seen surrender charges, now we are seeing GST, multiple headwinds in terms of realizations. Just from a profitability perspective and, from a, more medium-term perspective, what do you think can be the growth trajectory in this business? And is there a way you can really pass on a little bit more to the underlying POSP agents? And the reason I ask this is because there are multiple POSP platforms in the country which obviously pay much higher realizations or much higher pass-through rates. So those would be my 3 questions.
So to give the answer of your first question, comparing 2019 and comparing now, so 2019 AMCs have passed on majority of the hit. Currently, after the consultation paper, what kind of hit they will be able to pass it on, I think no AMC will currently communicate officially. But my guess is that whatever would be the impact this time to the AMCs, majority of the hit, AMCs will pass it on to distributor. That is what my reading after discussing with them. The reason being, last 2 years, many of the AMCs have done the TER cut on the book when there was no regulatory changes. In spite of that, I think AMCs have cut the book commission for major of the distributor to maintain their margin. This time it's a regulatory change. So my gut feeling or my discussion with them, this time they will be able to pass it on. They will pass it on majority of the cut to the distributor. That is what my reading is. I don't know how finally they will act. But as of now, the reading is they will pass it on the major one. The second point is the attrition of top 20% partners because new platforms are paying higher commission and a lot of competition has emerged in last 1.5 to 2 years. I would say that the trend, in case even if there is an attrition, it would be on a smaller AUM partners, not on a bigger AUM partner. The reason being the bonding of bigger AUM, the involvement of our team with the bigger AUM is much stronger historically also. The smaller AUM partners, their engagement, their relationships, probably I think are building new or anyways I think the relationship that might not be stronger because of the smaller scale. Second point, I would say that all these new platforms are paying the flat commission which is on a higher side. Mainly that would make a big difference to the smaller size AUM. As you know that in Prudent, we already have a tiered structure. Smaller the AUM, lower the commission, higher the AUM, higher the commission. So probably the commission impact or the commission difference would be seen by the smaller distributors versus Prudent versus new platform. So the bigger AUM partners moving or to the join the platform, I think that trend is not there. So attrition, I would say that there is hardly any attrition. Rather, I would say there is a zero attrition among the top 10% partners or 20% of our partners. If at all there is some attrition, it would be on the smaller AUM partners. And again, it is not universal. It would be on a few branches where my team would have joined the competition platform because of the relationship they would have gone there. Again, that would be on a new business, part business, not the full business. So attrition-wise, we have not seen any meaningful attrition in the last 1-2 years. Third point you said is the impact of insurance due to GST, due to the surrender charges guidelines which impacted the revenue last year. Definitely, I think this time post GST, the impact would be much higher, mainly on a health insurance side because the revenue might come down by around 18%. Entire the GST component might be transferred to the distributor community. So impact of revenue on a health insurance side definitely would be higher. On a life insurance side, as of now, I think still insurance companies are discussing, negotiating. So we are not sure that how much percentage finally would be passed on to the distribution community. As of now, the discussions are on. I would say that in the health insurance side, more than 70% of our business got impacted in the health insurance side. 30% currently under negotiation, under discussion. It is not impacted in the month of October. If I take the similar case for life insurance, 30% got impacted in the month of October. 70% still the discussions are on. So what would be the final impact? I think once we finalize our discussion with the insurance companies, we'll be able to communicate. But yes, I think whatever would be the impact or pass on the impact to the distribution community, I'm sure I think they will do for the agency channel also. So when they do with the agency channel, when the insurance company is passing on to all the distributors, we will be able to pass it on to our distributor also, at least in the proportion of our sharing ratio. So we don't see a bigger challenge. At least we are very confident that we'll be able to pass it on the hit at least equal to the sharing ratio or a little higher in insurance as well.
Got it. So just one follow-up in the first part, if I understood correctly, what you said is that because mutual funds have demonstrated a capability to pass on to distributors even during absence of regulatory changes, you think that this time around also majority of the AMCs will pass maximum portion of the impact to the distributors? Is your understanding or hypothesis or something? Is that the right understanding?
Yes, that is what I believe.
Got it. Thank you and all the best.
Thank you.
Thank you. A reminder to all the participants to press star and 1 to ask a question. The next question comes from the line of Sanket Goda from Avendus Spark. Please go ahead.
Thank you for the opportunity. So my first question is on Indus, the 2,000 odd crores of AUM. If it gets added, how much yield kicker we will get? And that 124 crores cash payout, what we did, how long it will be amortized over the period? So that's my first question.
So Sanket, I think the 2,000 crore is about 2% of our overall AUM. And more or less, my belief is that because, if you look at whenever the merger happens, this merger formula says that you will get the rate whichever is lower between two. So it cannot be yield accretive in any case. Let us say, for example, on a particular transaction, Indus is getting 1% and Prudent is getting 90 basis points, I'll get 90 basis points. Or, for example, in particular transaction, I would have got 1.10, but they are getting 1%, I'll get 1%. So, because of the merger rule, it has to be the lower of my rate or his rate. So, in that situation, it cannot be accretive to the yield as far as overall my broad yield is concerned. Number two is, as far as amortization is concerned, we are yet to talk to the auditor because, to be very frank, we are of the view that this is a asset which we have acquired. We have the couple of precedences like Carvi and IFAS. We believe that these are very long-term in nature as far as benefit is concerned, and we are able to demonstrate that benefit. So we'll talk to auditor, and yet we need to finalize that whether should we amortize over a period of 10 years or even more. So that question is at an open-ended stage.
Sir, in Carvi, our amortization period, what auditor ultimately decided was how many years?
So I think at that time we took 10 years as an amortization. So out of 150 crore, we are writing off 15 crore every year. But now almost 4.5 years is complete, and we have a very good track record to go and talk to them that should we continue with 10 years the formula or we should make some changes. So I think that's why I'm just giving you a hint that we'll talk to auditor.
Understood. And Indus yield will trickle down everything to bottom line, right? There is no leakage in the change.
Yeah, so because it's a pure B2C business, so as I already told in the opening remark, we are expecting about 22 to 23 crore of top line, and I think the profit before tax, before amortization would be about 15 crore. So there is a cost of about 5-6 crore for running this business.
Understood. Perfect, sir. And my second question is on your means if I look at the number of MFDs who have become insurance POS, that number is stagnating around 13,000 odd people. That number has not grown. So just wanted to understand whether the incremental addition of mutual fund MFDs doing insurance will be is becoming difficult, or we have seen the benefit what we or these are the guys who can get it.
So basically, I would say that last 1 year we were migrating our insurance business from GenNext to Prudent. So earlier, whatever recruitment or the POS registration we did, it was in GenNext. From 1st of April, we started doing business, majority of the business in Prudent. So obviously, we had two challenges. We had to migrate, we have to recruit the new POS in Prudent, and also those who are willing to shift their POS registration from GenNext to Prudent, we also had to accommodate them. So obviously, last I think 6 to 8 months, our efforts were also converting, or those who are willing to migrate their POS license from GenNext to Prudent. So obviously, hence I think the focus on new POS registration was less, and that is where you are saying that it is stagnated. But still, I won't say it is stagnated. I think still there is a growth of new POS month on month. Also, we are able to see the growth in the POS number also.
Understood, sir. And another question was on insurance. Basically, in the initial remarks, you said that in life insurance, 30% of the business saw a commission cut. So when you say 30% is unlike 70% in case of health, any particular product where you have seen the highest pain, like protection or units or non-par, anything away?
So in life insurance, I think when we say around 30% business already have communicated that I think the GST impact would be passed on. One, on the insurance company side, a few of the insurance companies have said that entire business got repriced with 18%. That is one. And few of the insurance companies have said that we are just waiting and watching, and we are just discussing with them for the entire product basket. One or two insurance companies have passed it on a ULIP side. So just I think it's a mixed bag. So on the total side, I would say that around 30% business got impacted.
Okay, so there is no consistent trend like health insurance?
There is no consistent trend currently. No, there is no consistent trend currently. Still, it is under very discussion stage. Finally, I think we believe that I think final outcome would only be known by March quarter only. I think few more insurance companies will give the clarity probably in this quarter. You still will take the next quarter to give the final long-term changes or the update. So final outcome probably would be known on 1st of April only. That is what my belief is. But yes, I think we'll get more clarity during this quarter, and few more companies might confirm by next quarter.
Understood, sir. And lastly, on AUM mix, can you just give an AUM and net flow number or gross flow number? Can you give a color how the AUM is in small, mid-cap, hybrid or flexi and vis-a-vis to the SIP book or gross sales numbers?
So you are talking about the mix of AUM?
Basically, I want to know the mix of AUM too, and how different is incremental sales compared to the outstanding book.
So mid and small contribute almost, I think we simply only look at these two categories, mid and small. In terms of assets, I think they are around 23-24% of my equity assets. And simply if I look at non-debt, around 23-24% is contributed by only mid and small. This we are talking about on the AUM side. Yeah. Simply if we look at the gross sales side also, I think my numbers in this financial year is almost 23-24%. So practically I have not seen a big difference in terms of AUM composition of mid and small, which is around 23%. When I look at the gross sales composition, it is around 23.5-24%. So we have not seen any significant change in terms of AUM or in terms of gross sales. So net sales, again, I think the contribution was around 25-26%. So there is no significant trend in terms of sales in gross and sales in mid and small. Probably the SIP registration or SIP this thing, the contribution of small and mid is much higher. This is around 1/3 of our new SIP registration is in small and mid. But historically also, small and mid contributes around the similar kind of number in terms of new SIP registration.
Understood, sir. This is very useful. Thank you very much.
Thank you. The next question comes from the line of Pranuj Shah from 3P Investment Managers. Please go ahead.
Hi, hope I'm audible. Thank you for taking my question. I just had one clarification on the insurance bit of it. So when you say that 70% in health and 30% in life is where you have seen the GST impact come in, so is this where your commissions have been negotiated down by 15% so that whatever GST you used to pay has been passed on to you?
So practically earlier, whatever my commission used to be, let us assume my commissions were 20%. On 20%, they used to pay the GST. So 20% plus 18% of 20%. That is how the insurance company used to pay. Yeah. When we said that 70% business got impacted in terms of health insurance, the 20% commission, the assumption of 20% commission is continued. But now the communication is that 20% includes the GST component. So earlier the commission, say for example, 20 plus GST, now it is 20 minus GST.
Perfect, yeah. That was my only question. Thanks a lot for answering it.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question comes from the line of Lalit Dio from Equirus. Please go ahead.
Yeah, hi sir. Just two questions. So firstly on this new product, with a new category which is SIF. So we have seen 2 launches in the last 2 months. So just wanted to understand what kind of an AUM did we participate in those two products, and whether we raised any amount, and what would be the yields and the sharing ratio if you have done this?
So we are very, very bullish on this new category. Unfortunately, number of certified MFDs in the country are yet very, very low, and hence in our system also, out of our 35,000 ARN holders, those who are certified to sell SIF are less. Hence, the participation of partners in SIF business is very, very less. While we are talking, almost more than 200 plus partners are certified. I think industry numbers are around 3,000 plus somewhere. In industry, around 3,000 plus CRN holders are certified for SIF. The same number for us is around 200 plus. We participated in SIF, but obviously we did not participate very, very actively or aggressively. Main reason was because since this was a new product, the technical integration was not ready by RTA. So first two NFOs we missed because the integration did not happen in our Fund Puja portal. But having said that, still in first two NFOs, we did around 9 to 10 crores.
Awesome. And just on this back book repricing, so any other AMC where there are some active discussions on this back book repricing on the mutual fund side, or?
So currently, no AMCs right now talking, but as one or two AMCs have already communicated, specifically in Nippon, that they will revisit their TR sharing every quarter, every half year. If there is a big yield pressure, they might change on a back book side. As a process, only Nippon has communicated. Other AMCs, occasionally, when they feel the pressure, they will pass it on. But currently, there is no discussion with any AMC.
Awesome. Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask questions. As there are no further questions, I would like to hand the conference over to the management for closing comments.
Thank you everyone for attending this call, and if there is any question which has not been addressed, or if you have any query, I think the management, including Parth, who handles our IR, is all the time available to you guys. Yeah, thank you.
Thank you so much, sir. As on the behalf of Equirus Securities Private Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your line.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.